Okay, last talk of the day. But if you think that you've heard a lot about disagreements in macroeconomics so far, I guess I'm going to try to show there are some points of agreement also. So there have been clearly dramatic changes in monetary policy since the end of Bretton Woods. We talked a lot about them so far in this session. Things like the zero lower bound, quantitative easing, and so on. These were previously sort of abstract theoretical ideas, but have in the recent period become part of common parlance. You even see them in newspapers and so on and so forth. But over this period, over a longer time period, there have also been dramatic changes in much more basic questions relating to monetary policy. And in some sense, these things underpin the development in these more complicated ideas. So for example, is monetary policy about money? And do interest rate rules work? So these are the things that I'm going to focus on because the presenters in this session also have made important contributions on these points. So let me start with some deep background. Here's a figure from Michael Bordeaux, which is the monetary gold stock and the purchasing power of gold. And you can see that when the world was on a gold standard, these pictures are from the classical gold standard, during periods when there was a rapid increase in the gold stock, during those periods there were also declines in the purchasing power of gold. In other words, there was inflation. And on the other hand, when the gold stock was not rising very rapidly, there was deflation. So one of the consequences of the classical gold standard was that the price level and inflation were subject to the vagaries of the gold market. If there was a lot of gold discovered, that would lead to inflation. And if there was a scarcity of gold, there would be deflation. So there were sufficiently large problems with this kind of system that some of the elections in the late 1800s even focused on issues associated with monetary policy, like the election between McKinley and Bryan, and so in principle you want to think about a different system. One alternative was to focus on to think about the idea of a constant growth rate of money instead of pegging money to gold. But this too turned out to have huge, basically unsolvable practical problems, mainly that money demand shocks are huge. So in particular in the modern world, people need a lot of money, for example, to buy Christmas presents. In an agricultural economy, they needed a lot of money to plant crops and during the harvest season. And then there are things like the fact that with the development of credit cards and so on, you just don't need to carry around cash. And you can even imagine an economy where you have credit cards linked to interest-bearing accounts, and then you don't have to have any even money in your checking account. So these are really big practical issues. And if you look at interest rates in the classical gold standard, you see the consequence of this. So this is a graphic created from data in Mankiw, Myron, and Weil. And you see that during this time period, interest rates toward the end of the year were almost a percentage point higher than during other periods. And they attributed this to higher demand for money during the planting and harvest season. If you look at velocity, this is velocity using M1, you can see that over the time period before 1980, which was the time period that Milton Friedman and Anna Schwartz focused on in advocating monetarism, velocity grew at a relatively constant rate, but subsequent to that was extremely unstable. Now I should mention that they tended to focus on M2, not M1, but velocity in terms of M2 also looks very unstable, though different. And if you focused on a constant money growth rate, these money demand shocks would lead to large fluctuations in the interest rate, which you wouldn't want as a feature of monetary policy. So, a natural alternative to consider would be interest rate rules. But there was very serious theoretical debate about whether targeting interest rates would actually work as a practical policy. So a famous paper by Sargent and Wallace in 1975 argued that targeting interest rates would lead to indeterminacy. They were comparing interest rate rules to monetary rules using monetary aggregates. And they showed that in the case of the interest rate rule, now at the time they were focused on an exogenous interest rate rule, would lead to indeterminacy. As I mentioned, they were focusing on this exogenous interest rate rule, and the later literature showed that this was a very important distinction between exogenous interest rate rules and endogenous interest rate rules that would follow something like a Taylor principle. But that was something that was really sort of established in the subsequent literature and wasn't a focus of this early article on the topic. So in the context of this kind of debate about whether interest rate rules would really work, you could view it as a sort of pioneering action when Canada and Australia in the mid-1990s switched to a very explicit system of interest rate targeting. Now, I don't know whether they thought of this as a pioneering action. Canadians like myself are not typically thought of as revolutionary people. And also whether or not you think this is pioneering also depends on what you think the US monetary policy had been up to this point. I mean, if you look at the Fed minutes, they talked a lot about interest rates. Some would argue that they had also been interest rate targeting for a long time, but that certainly wasn't explicit. And they certainly also did at times look at monetary aggregates. So this was clearly a much more explicit system of focusing on interest rates than what had existed previously. They also eliminated reserve requirements, which dramatically reduced the demand for money. And so it was really much more explicit about using interest rates as the policy instrument than earlier monetary policies had been. I think it's useful to contrast this versus ISLM, which is still one of the main tools that we use to teach undergraduates about how monetary policy works. In ISLM, the way monetary policy is implemented by the central bank is that it's about trading off interest-dominated money, so often money pays no interest in these models, but it could just be interest-dominated, versus interest-bearing bonds. And this kind of trade is called an open market operation, and by trading money for bonds, the central bank controls the interest rate. And this leads money and interest rates to be negatively correlated in this kind of system. Now, the corridor system, which is the kind of system that Canada and Australia adopted and now the rest of the world has also adopted, is quite different in terms of these basic aspects of how it functions. In the corridor system, the central bank chooses a narrow corridor around a target overnight interest rate, and it stands ready to supply an arbitrary amount of interest-bearing reserves at the upper bound of that corridor, I upper bar, and to take in arbitrary deposits at the lower bound. So the idea that was central in how monetary policy is implemented in ISLM, these open market operations trading off interest-dominated money and interest-bearing bonds, really plays a very secondary role in the corridor system because reserves now pay interest. So they're interest-dominated, but only by a tiny amount, by the width between the lower bound of the corridor and the middle of the corridor, which is the target interest rate. And then the money demand shocks that I was emphasizing before as such a practical issue for monetary policy are just offset as the central bank accommodates these kinds of shocks and keeps interest rates within this narrow window. Now, in the context of this earlier debate about whether interest rate rules might in principle be a somewhat dangerous thing, you might have asked, would it work? And I think the answer is that by any reasonable measure of success, the corridor system did work. So here's a picture from Mike's book of interest rates, both the target, the actual interest rate, and the interbank interest rate, and then the width of the corridor in Canada, starting sort of when they implemented this system and until 2003. You can see that they were able to stabilize interest rates very precisely around this target interest rate, and in fact the volatility was much lower than for the United States, which was not using at the time this kind of a corridor system. If you look at inflation, this is inflation. Here's 1999 or so when they were implementing this system. There's no obvious change at all in inflation dynamics. So it appears, and this is kind of echoing, I guess, some of John's presentation, that by any reasonable measure of success, the switch to the corridor system worked. Since then, this kind of system for implementing monetary policy has really become the industry standard around the world. This kind of system is easier to implement than previous systems because the central bank can just accommodate these money demand shocks. And presumably that's why we've seen, since this early adoption by Canada and Australia, many other countries around the world adopt this kind of system. The Fed now operates, instead of targeting the middle of the window, a floor system where they supply a sufficient amount of reserves to hit the bottom of this window. Now, If it had been the case that monetary academic work in monetary policy had not changed since those early years I described, I think that at present, with this shift to the corridor system, monetary economists would be sitting on one side of an enormous canyon between monetary theory and what was actually being done in practice. Because the earlier theories which focused on money at their core, and these sort of LM curve ideas, would have been very difficult to use to interpret this kind of a practical policy implementation system. But fortunately, that was not the case. There was a lot of evolution in terms of monetary theory over this time period. So, there's Mike's work on the cashless economy that I'll talk about more, but which is thinking about this situation where you don't have any non-interest-bearing asset. And then there are these issues relating to, that they relate very much to John Cochrane's presentation. So, as I mentioned, early work on this topic had argued that interest rate rules might in some sense, or interest rate targeting might in some sense be quite dangerous in leading to indeterminacy. And an important early contribution was to recognize that if you considered interest rate rules that were endogenous in the sense of following a Taylor principle as opposed to exogenously specified, then you could get a unique bounded solution for the price level. Now, why focus on the unique bounded solution? That's in some sense a lot of what John was talking about. There have been different arguments for why to focus on the unique bounded solution. So one idea that both Mike Woodford and Obsold and Rogoff have focused on is the idea that you might think about a commodity trigger rule to rule out the situations where you would get either a hyperinflation or a hyperdeflation. Other proposals include the fiscal theory of the price level, which John talked a lot about. Now, all of these ideas rely on sort of hyper-rational understanding by the participants about things that are going to happen to inflation in the far, far, far future off the equilibrium path. So another set of ideas has to do with learning. These are ideas that Evans and Hakapoja developed, and that, for example, Marty Eichenbaum and Larry Cristiano have been focusing on in recent work, partly responding to John Cochrane. And also these ideas relating to K-level thinking that Mike has been working on in recent work. So all these things are kind of ways of thinking about why we might want to focus on this unique bounded solution. At the same time that theory was evolving in a way that made it easier to understand the practical implementation of monetary policy in the modern world, the empirical work was also shifting. Here are a bunch of empirical papers on trying to estimate the effects of monetary policy. And you can clearly see that over time, the variable that people have used to describe the monetary instrument has shifted from money to interest rates in the more recent literature. And this has had advantages in terms of power because, as I've discussed, there are very large money demand shocks. So including money in your regression becomes problematic in that context. So one thing that may be sort of a nagging concern in the back of your mind as I talk about this is that I've talked about the notion that in this corridor system, the Fed doesn't necessarily have to have any, there doesn't have to be any interest-dominated cash or zero interest cash in the economy. So this is what Mike calls a cashless economy. And you might be thinking to yourself, if there's no cash around, what is it that gives the Fed its special power if it's not the ability to print these little green pieces of paper? And the answer that Mike in his work has given is that it's not these little green pieces of paper. It's really fundamentally the fact that the Fed has the ability to provide these reserves, interest-bearing reserves, in units of dollars. And that dollars are special because they're the unit of account. So if the Fed was able to set the nominal interest rate in units of dollars, but prices were perfectly flexible, then why would anyone care what the interest rate was in units of dollars? But there's pretty strong evidence that, for example, when nominal exchange rates depreciate, we do see changes in real exchange rates. And that when nominal interest rates move, we do see changes in real interest rates. So these things suggest that the unit of account does matter. And in that context, even if we don't have these little green pieces of paper, which don't bear any interest, the Fed still has power purely because of the fact that it can determine the interest rate in units of the unit that are used to set prices and contracts in the economy. So let me close by talking about a practical implication of all this, because you might be thinking this sounds kind of abstract. Does it really matter? But I think it does matter for interpreting very practically important things in the recent period. So one graph that one saw quite frequently during the financial crisis that sparked a lot of interest was this graph of the monetary base, where you saw this huge spike in M0. And this was taken by many people, both in financial markets and in the popular press, to be something that should raise fears of a hyperinflation, because M0 just went up by almost 4 times. Now, if you ask monetary economists, generally speaking, they were not afraid of a hyperinflation. Why? Well, I think this was one case where it was important to remember the plumbing, the details of how all of this implementation stuff worked. So it's hard to see from the graph I showed you, but this explosion in the monetary base actually happened before interest rates hit 0. It happened before we got to the 0 lower bound. The proximate cause of the major increase in M0 was the fact that the Fed was doing these major credit easing programs. So they wanted to expand these credit easing programs. But at the same time, they didn't want the Fed funds rate to hit 0. So this was actually the beginning of the Fed starting to pay interest on reserves. But of course, because they started to pay interest on reserves, there was not as much of a penalty to banks from holding these reserves. And in this context, it's not surprising that there was a big increase in reserves at this time. So I think this was one of these cases, maybe there are not enough of these cases, where monetary economists were actually right about this for the right reasons. And finally, one of the things that Guido reminded me about in a conversation yesterday was that these exact credit facilities were in some sense a resurrection of the LM curve type of ideas. So I've emphasized that these money demand kind of ideas don't really play an important role anymore in how the Fed funds rate, the conventional monetary policy, is implemented. But at the same time, if you think about these credit easing programs, a lot of them were ones where the Fed was buying these high interest rate, risky assets in an effort to drive down the spread. And there's a sense in which this is kind of a resurrection of some of these older ideas having to do with an LM curve. Thank you.
Okay, thank you. So we have some time for questions. I want to make just one comment, if I could. Beautiful presentations in many dimensions. I actually agree with Stephanie. The calculation, it doesn't require the fiscal theory of the price level. It's just a simulation of a model. It's not actually dissimilar to simulations of other rational expectations models with forward-looking wage and prices. Sometimes the simple price equation you have now means the interest rate can just be gradual that way. Sometimes it used to have to go up very slowly and then speed up, so the curvature of that path was important. So I think it's basically correct. Maybe the model needs to be looked at, but I encourage Marty and Michael and John to look into that. But those are questions for all of you. But let's take some right now, in the back here.
So sorry. Yeah, this is a question for Stephanie. I mean, I'd like to understand better the transmission mechanism of monetary policy. So the Fed makes an announcement, we are going to increase rates permanently. And then people think, oh, okay, that means that my expectations of inflation should go up, and that means real rates are lower, and I should run to shop. But I have a mortgage. I mean, how do you work out the cash flow constraints in people's finances, and how do you explain this to, and
Okay, we'll put that in Mike, and then Ben, right here.
So, okay.
Many central banks, especially this one, the Riksbank, are seriously exploring establishing a central bank digital currency in cooperation with the commercial banks. And if they do this, and the use of cash declines significantly as it has in this country, then they can use their interest rate on reserves to target the price level, as was discussed at the beginning of this session. They could cut the interest rate on reserves below 0 in case of a fall in aggregate demand, and they would avoid the need for the buffer that you have in an inflation target.
Thanks, Mike.
if you can make it credible by saying I'm going to raise the interest rate, that's great. I suspect there'd be a train wreck if we actually tried to do it that way. Maybe in a different universe, where people had been conditioned differently, it wouldn't. And then I was going to say something like what Mike said. I mean, I think you don't even have to go to a cashless society. Having negative interest rates, you can exclude small retail depositors. It's completely understood how to do this. Yes, it would take a few years to lay the institutional foundations, but a lot of the incredibly extravagant alternatives that people have considered to negative interest rates, I think ought to be at least considered in the context of that alternative.
Harold?
Yeah, just a small comment on Stephanie's point. I mean, permanent sounds awfully long, right? I mean, the long run, and so forth. But, I think the distinction between temporary and permanent is a little exaggerated, right? If you go from temporary to permanent, this is a continuous change. So at some point, persistent is enough. You don't need to raise interest rates forever. It's enough if you raise it, reasonably persistently, right? So that was the point of my presentation. And what happened in my presentation was that it doesn't take all that long, right? You don't have to promise that nominal interest rate for all that long. So now that was done in my model in my presentation for a very simple three equation Keynesian model. Would be interesting to do this in a fully calibrated estimated model, but that's an empirical challenge. And I think one could then figure out what's the path that it would take so that one doesn't see the temporary inflation decline that might come with inflation, with interest rates that are too fast. Now, it's true, I share Ken's concerns that this probably has the opposite effect, right? We are also conditioned by our standard undergraduate ISLM textbooks that we think this cannot work, but what we have learned over time is that some of our theories don't work. So perhaps it's time for some courageous renegade central banker, perhaps in Canada or elsewhere, to try that policy in somewhat more normal times and see what happens.
Pete Kyle, right here in the front.
So I have this very simplistic way that I've been thinking about how interest rates sit at zero. If we live in a world where the savings rate is really high, and it's so high that the housing market and the industrial sector can't really employ all those savings unless the interest rate, real rate, is very negative. What's going to happen is government's going to run deficits, and if they run gigantic deficits, they will eventually push the real rate forward, and you'll come off of zero interest rates and be back to normal. But if the government deficits aren't big enough, you'll sit there for a long time. So even though Japan's have been quite big, they're not big enough. Same for Europe, but the U.S., they are big enough. Is that right? Is that consistent with what you were saying, or is that just off the wall?
So I'll answer that. Lars?
Okay. When theories
Getting a little
disagree,
inflation is hard.
we need a natural experiment.
Ask a Latin American.
And the Riksbank provided one. In 2010, my colleagues in the executive board, against Carolina's and my dissent, wanted to normalize monetary policy, normalize interest rates, go from from 25 basis points to 200 basis points. And they did so in 1 year from 2010 to 2011. What happened? The inflation rate fell from 2 to 0. The real interest rate rose by 2 percentage points. The krona appreciated. High unemployment, which was on its way down, stopped going down, flattened out, and even increased a bit. A couple of years later, 2014, there was a complete turnaround. The policy rate was lowered quickly, stepwise down to minus 0.5%. What happened? The inflation started moving up towards 2. The real interest rate fell. The krona depreciated quite a bit, and unemployment started coming down. This shows that, at least in Sweden, monetary policy works like clockwork, exactly in the direction that the textbook Sorry? Everything else too. Arguably everything else too, yeah.
Okay, last question, Ricardo.
Make one observation, one question. The observation is that in the last, so the Bank of England has 400 years of history. The last 20 years are the lowest median standard deviation of inflation ever. This is true in many other countries as well. And so, while I very much disagree with Harold in saying we need to experiment because things are working really well and you don't want to break you don't want to fix what's not broken. But with John, I agree very much that yes, this last 10 years have led to puzzles on how is it that we control inflation. But it is still the case that the combination not just of interest rate rules like Emmy pointed and corridor systems and Mike has worked on, but also, and going back to something Helen McGrath said earlier, central bank independence, which is a very big part, the rules institutions, have delivered immensely good outcomes. And I think often this discussion gets lost on we have a lot of fun with a theory, maybe it's this, maybe it's that, oh, we don't know anything. We've achieved amazing outcomes in the last 20 years when it comes to inflation stability that had never been achieved across so many countries, across so many places. So I needed that observation because I think sometimes discussion gets misinterpreted as a failure. In terms of the question, like Emmy pointed, I think we started by focusing a lot on the money demand equation, and empirically it turned out to be somewhat unstable and didn't work very well, and that was the deathbed of monitors, if you want. We've shifted to thinking about the Fisher equation. A lot of the corridor rule is really about arbitrage between nominal and real, and that's what's driving together the combination of interest rate rules and what controls inflation. John would like us to shift and think about more of the government budget constraint. That, of course, has very big errors in terms of the present value of fiscal surpluses. But if we stay within the interest rate rule, like Emmy pointed, and like a lot of Mike and even Stephanie Sharp works, I think we have to connect to what we heard in the last 2 days, which is that in that no arbitrage relation between nominal and real bonds, that's really driving everything, the efficacy of all of it, from what Stephanie, Emmy, and Mike said. There's big shocks there. There's term premium shocks. There's risk premium shocks. Those seem to be related to quantities again, not of money now, but of credit and others. And so as much as focusing on interest rates, it's focusing on one equation, thinking very hard about the other determinants of that equation. And those are very related to financial factors and others that I think the theory does have to adjust to if we want to stay within the corridor kind of way of thinking in interest rates.
Thank you. I think if you take any of the models discussed, it's a challenge to do a calculation like Stephanie did, to, in an anticipated way, raise the interest rate. It doesn't have to necessarily be the way she indicated, but some way that generates a Fisher equation each point in time. I think that I've seen it done in other models in the past, much more complicated. I bet you can do it in your model too. But anyway, let me give them a chance to answer. Mike and then Stephanie.
Okay, I wanted to respond to Ben's comment. I mean, to clarify, I did not mean to say that forward guidance accomplished nothing or can accomplish nothing. In fact, in the recent papers I've written about a more realistic, what I think is a more realistic analysis of the effects of commitments of that kind. I mean, I stress that I do think that not only that they should have an effect, but that it should be stimulative. The question is whether one should expect the effects to be as strong as the rational expectations analysis of assuming that the commitment is perfectly understood. And that's a somewhat heroic assumption. It's particularly a heroic assumption if one were making commitments further in the future. So the rational expectations models imply that in principle, one should be able to completely solve the problem by a long enough commitment, because this should be an extremely powerful tool. And that was the thing that I was intending to question, and in particular to question whether it could achieve perhaps as much stabilization as if one had committed to a price level targeting regime before the crisis ever occurred. In the case of John Cochrane, I should say first, there is at least one thing that he said that we definitely agree on, and that was about Scrooge McDuck. I mean, his statement that we should now believe that it's possible to have the optimum quantity of money and be a stable regime. I think that's completely right, and basically the point is to recognize that you don't just have variation in the supply of reserves as your monetary instrument. You can vary the interest rate you pay on them, and once you realize that, you can have the quantity of reserves needed for efficiency of the payment system, and it doesn't in any way imply loss of loss of control of inflation or other short-run stabilization objectives. On the questions about the problems of the new Keynesian analysis of the effects of interest rate pegging policies, I guess I would stress that the embarrassing conclusions that you are talking about do depend on assuming rational expectations. And in the case of very long-lasting, say permanent interest rate pegs, so the conclusion that you should get sunspot volatility if you peg the nominal interest rate forever depends on solving for rational expectations equilibria under that, and the puzzles about the explosive effects of very long-lasting but finite are also dependent on assuming you have the exact rational expectation solution, even in the case of a long-lasting commitment. What I've shown in recent work, including the paper with Mariana Garcia-Schmidt that you mentioned, is that you don't have to back off very far from full rational expectations to change those conclusions a lot. And I would not agree with the suggestion that everything falls apart in the rest of macro and finance if you back off from rational expectations in that way. I mean, what we show is that, for example, predictions about the effects of a monetary policy described by a Taylor rule are very little changed by modifying the rational expectations assumption. And it's a peculiarity of committing to a fixed nominal interest rate for a very long period of time that you have this fragility of the conclusions.
Thanks. Stephanie?
All right. First of all, thank you very much for John and Emmy. Yeah, I get confused when I say John and Emmy, but it is John and Emmy for the comments. So these are really very nice comments. So I just want to clarify something. In this multiplicity that we initially pointed out in the work with Jess is one in which it depends what are your inflation expectations. So I can give a spin to how the US exited very successfully of the type you just announced. I think real GDP per capita is growing at normal rates. I think, you know, like if Europe were to make a recommendation, I see employment to population ratios recovering. And so I think we normalize, and therefore we're going to very slowly raise rates. That will be the narrative. So I don't know if that narrative wouldn't be credible, because what is there to check? Why would the market think this is a crazy idea? They would have to have a diagnosis that there's a new fundamental shock. And to the answer to Lars, why it didn't work in Sweden, well, people had Sweden right. I mean, they didn't stick to their guns. So yes, I think this is so I don't think it's a counterexample, but you know, I think what the US did can be interpreted in this way. It's just how you phrase it, because we hope that it should be very easy to convince agents in the economy that we're going to go back to our promised inflation targets, say the US going back to 2, and Japan convincing people that they're just not going to tolerate this situation of being forever at 0. So,
Thank you. Thank you all.